We're not doing that again. All right, let me get a couple things going here. All right, I think we're good. Welcome to the Intelligent Investment Show Live. I am Garrett Lale here with the always intelligent and clean looking Matt Dahl. And every time we do this, I never really explain the show or what we do here. So Matt is the founder of ARPG, Intelligent Investment out in Las Vegas. I'm Garrett Lale. I'm a certified financial planner. I'm not a practicing financial advisor anymore. So I still have my CFP designation, and I love to talk the markets, but I'm a retired player coach, I suppose you'd say now. So I'm just here to kind of guide the conversation. I have the Wealth Partners Network. We put out content like this. So if you're stumbling across this and wondering who the heck we are, that's our background. Matt, good to see you as always. I really probably just need to record an intro, and that way we don't have to do it every single time. You think 35 shows into it, we would have simple things like that nailed down, but learn as you go, right, brother?
We never stop growing. We never stop getting better. We never stop challenging ourselves.
That's right.
Yes, you are. Right. You know what? You are a CFP. I forgot about that. That's
right.
That's an impressive thing. And honestly, that's what makes you so good at this is like the advisors that work here for me, they're great at basically being the interpreter of things that I say.
Yeah.
They're able to and help people understand and articulate very complex subject matters and events to clients and kind of bridge that gap. And they're really good for people. It's really great for clients or people, potential clients, or just the general public trying to understand what marble mouth dorks like me have to say.
Well, there's a very it's a beautiful art to try to figure out how to take all of that just wealth of knowledge that you have in that brain, and then figure out how to somehow send that through a filter to make it make sense to the everyday investor, right? Because one of the things about investing is there's a lot of numbers, a lot of terms, a lot of acronyms, a lot of different things like that get thrown around, and the guys on TV really, really love to use words that nobody else understands. Number one, it makes them look smarter, and number two, it helps the public not necessarily even be able to tell if they're right or wrong or know what they're talking about because you don't speak the language anyway, right? So what we attempt to do on this show is to take all of that, the stuff that's floating around out there, and break it down into terms that make sense and apply to everyday people. Because at the end of the day, investing is not necessarily complicated. It's just there's a lot of moving parts, but it doesn't have to be complicated. So anyway, and we always do that with the token slogan that we've adopted, I believe, with objective optimism. We are the objective, optimistic crowd of the group. So Matt, this is our last. We're gonna be on vacation next week, so you got 2 weeks worth of knowledge to share in about 30 minutes here. So I hope you're on your game. You're looking fantastic. I did try to up my hair game a little bit this week. I was struggling last week, man. It really was a rough one, but I showered, I shaved, I did the whole 9 yards this morning to try to look especially nice for you and your
You look good. You look good. You're slick as a ball bearing this morning. You look good, nice and hairless. You're gonna glide right into that weekend.
That's right. That's exactly right.
Just no restriction.
Absolutely.
What's the right word? What are we looking for? Not the opposite, aerodynamic.
Yeah.
I'm losing the word. Anyway,
yeah.
Doesn't matter.
Well,
resistance. No wind resistance.
No wind resistance. Yeah. Yeah. Well, I'll tell you what, it's about 180 degrees here in North Carolina. I don't think there is any wind to resist anything. It's, but it is very, the air is very heavy So when you've got a lot of humidity, you do need some aerodynamics just to you're getting air resistance just standing still down here right now.
Well, then you need to stay away from Las Vegas. On the way to work, I saw Satan out on the street corner with a fan. It's too hot.
Oh wow!
He was actually on fire, looking for this place is too hot.
So this is a great. We're eventually going to get around to some investment stuff, I think here, but really good competition. I think we could have right now. I know you've got me on temperature. There's probably no doubt that you've got me on raw temperature, but I think North Carolina might be able to at least be in your ballpark if we go heat index to heat index, because you don't have any humidity out there. Everybody always says it's a dry heat. No, I'm sorry, 120 is 120. I don't care how dry it is, but what's the heat index there?
It's our heat index is usually really close to our temperature because we don't have a lot of humidity, but I'm not sure about that heat index because, when it's humid out, yeah, it feels heavier, but it also makes you sweat and that kind of cools you down a little bit. Here, it sucks the moisture out of you. Like, you're like you're a sponge that was left on hot concrete. There's just nothing. It's just dry. It's just dry on dry on dry. That being said, I want to say last August, early September, we were in Indianapolis actually racing, and there was a day it was 97, 98 degrees, and it was like 94% humidity. I don't know that I wanted to die, but I don't know that I really wanted to live. So it was pretty gnarly, and that's because I'm not used to that humidity. I will say, though, I came back from that trip and my skin and hair looked fantastic for about 3 days. And then I reverted back to my wrinkly raisin version of myself with all the moisture left in my body.
Yeah. It's a fine line. It's a balancing act. You can look good and feel bad or look bad and feel good, I guess. But and just to clarify, it wasn't the 500 in Indianapolis you were in. I watched that. I did not see you.
No. This was last Labor Day. Last Labor Day, we do the NHRA U.S. Nationals. Yeah, but I mean, it looked great. I was polished like Anna Nicole Smith at her wedding to that old dude. But 3-4 days later, I looked like Beetlejuice. So.
Okay, we've slipped too far down the rabbit hole at this point. I think maybe we need to talk some investments.
We're just getting started.
So what's going on in the market? So it's funny, man. Since I am I'm essentially retired, for lack of a better word, financial advisor, I don't have to keep up with the markets day in and day out. I'll be honest with you. I usually check the market once a week, about 12:30 Eastern on Fridays, because we do the show at 1 o'clock, and I would like to know what's going on. But when we talked earlier, you said the Fed has to cut now. They have to cut now. And I'm thinking, oh man, it must have been a rough week in the market. But no, the market's fine. The S&P is. I'm eyeballing the chart here. It looks like we're at all-time high on the S&P right now.
We are.
Okay.
Today.
So reconcile that for me. We are at an all-time high, and Matt is freaking out that the Fed has got to cut now. And that's going to be the title of the show. The Fed has to cut now, and the now, you should know, is in all caps, bold, because you were very animated. They need to cut now. So what's going on?
Right. So we're at all-time highs because it looks like we've had some big stress tests the markets had to go through, i.e. tariffs, a 12-day potential larger scale war, you name it. We've gone through all of those things. And now it looks like what the catalyst today was, I think it was two things. I think it was more that the China trade deal looks like the framework is sort of been put into concrete, and they're able to build on it. And what that's conveying to the markets is there is an understanding now between the United States and China, and they have something they can work with. They can talk. They're less at odds than they were 2-3 months ago. Okay. The other thing is PCE came in this morning, the Fed's preferred gauge of inflation. So estimates were for 0.1 month over month, 2.6 year over year. It came in, the headline said 0.2 and 2.7. The actual real number was 0.18. Okay, so let's dive into that right now. So what does that mean? That means the actual prices of purchased products rose 0.18% month over month. Okay, well, what also took place is overall spending for April. Okay, I'm sorry, for May. Okay, was down by 0.1. Was down by 0.1%. So we're seeing spending actually down, prices slightly up. What does that tell you? That tells you that prices are going to follow that spending, supply demand. It just is what it is. We can't have continued higher prices with lower spending, because the lower spending is demand with a capital D, right? That's your demand number. So we're starting to see demand starting to wane a little bit, and the PCE is sort of held in, but they're purchasing less. And to sort of make matters worse is personal income month over month. So consensus estimate, and if the Fed doesn't see this as a bright, shining, glaring 4th of July lady finger that's blowing up in their face to start cutting rates, and I don't know what it was, then I don't know what there is. So consensus estimates for personal income month over month was a gain of 0.3%, okay? Which means personal income would grow about 3.5 to 4% year over year, right? It came in at minus 0.4, a 0.7% swing. That's not a miss. That's like the guy got drunk in the bar the night before and slept in his car in the parking lot and never showed up to the game. That's how bad of a miss that was. Okay. And again, that's, now you have the precursor to the precursor. The precursor to consumer spending, which was down 0.1, is the income available to make the purchases. Now, what they're purchasing, again, that was up 0.18, but the spending was down 0.1, and the income that led to the spending was down 0.4. So this little snowball is starting to roll a little bit, right? The other thing is, and we talked about this last time, was jobs. Jobs came in at 139,000 for the month of May. Okay. Consensus estimate was 130,000. That's not great. 139,000, although it beat the estimate, it's still not great. But what we have now is, if you look at the 3 months, the what they call the 3-month average of new job creation. Okay. Right now it's 144,000. Okay, for March, April, and May. That's 144,000 average jobs created on a 3-month average. A year ago through May, the 3-month average through May of 2024 was 249,000. Again, that might be a bit high, but we've seen a 40% reduction in that 3-month average. Okay, 144,000, that's a little low, but look at that direction. Look at the speed of that move. Things don't ever just go to where they're supposed to go and stop because that's where we want it to be. They continue down those roads, right? Again, the Fed is not flipping a speedboat around in the middle of a river here. The Fed is turning an oil tanker. Okay.
Yeah.
Okay. Maybe 10 oil tankers. Okay? It's that big of a job. So we're seeing material cooling in the labor markets. We're seeing a huge miss in personal income. We're seeing a huge miss in actual spending. Okay. And a decrease in income in spending, and we're starting to see more cracks in the housing markets. Okay, and Bill Pulte was on this morning, and he's actually asking for Jay Powell to resign. I think that's obviously overboard, and I understand where that's coming from. And I think Jay Powell, for the most part, deserves a lot of credit for keeping us from going into recession when inflation skyrocketed. But again, the argument can be made that the Federal Reserve, were part and parcel to creating it. I remember mid-late 2021, we started seeing 5.8% inflation numbers, 5% inflation numbers in late 2021. And what was the term that they threw around during that time, after we had many months of this expansion of inflation? Transitory. Inflation is transitory. It wasn't until December of 2021 they said they're going to retire the term transitory, and then they went.
Can you do that? Are you allowed to just decide we're going to retire a word?
Exactly. I didn't know that was part. I guess maybe that's the Fed. Maybe the Fed doesn't have a dual mandate. Maybe they have a thrice mandate. Right.
That just sounds like a little bit of an. That just sounds like a little bit of an overreach of power on your part, on their part, right? Like you're in charge of certain things, but you don't get to control English language and decide we don't use this word anymore. It just seems like a big step to take to say we're going to retire the word transitory. I mean, that just, I don't know. Sorry, side tangent, doesn't really matter. Has nothing to do with the show. I just think that it's an overreach of power.
I agree. But they said we're retiring the word transitory in December 2021. Then what happened? 2022, March 2022 came around. That was their first rate increase of 25 basis points. Then we had 50 basis points in May. And then they said they weren't going to raise ever by 75 basis points. And then 3 weeks later, they raised by 75 basis points 3 times in a row. Okay. To unwind this ball of yarn that they basically created. And now they're saying they need to wait and get more clarity, uncertainty surrounding tariffs, the uncertainty of inflation surrounding tariffs, all these things, uncertainty. Well, we haven't seen anything in the hard data yet. There's nothing anywhere in the hard data that's showing that these tariffs have any imposition upon inflation. And if so, and they have also admitted that this would be a one-time, largely a very temporary. Maybe they shouldn't have retired, because if there was a slight amount of inflation because of tariffs and it's a one-time pop-up in prices, okay, would that not be transitory? That's transitory, right? So again, you're right. They have no right to retire that word, because now we actually might have a transitory inflation problem due to tariffs. So if that's the case, and they know prices are going to go from X to Y because of a tariff, that's not real inflation. That is due to demand. That is nothing more than a tax. Okay, and now we're starting to see this tax start to weigh in on consumer demand and housing prices and consumer goods all across the board. I mean, I'm going to be a little bit bold here, and I think they're actually going to cut in July. I think they're going to do that. I think they're under so much pressure now, because now we have 2 of the 3 permanent voting members of the Fed, which is so you have the voting members, and they rotate in and out every year, right? I want to say about 2/3. They rotate about, maybe it's about half and half or so. I don't know what the exact number is. Rotate in and rotate out as far as voting members, except for 3. And that is, of course, the chairman, which is Jay Powell, the vice chair, which is Michelle Bowman, who I've typically not been a fan of, because she's been overly hawkish for no reason. Now she's overly dovish, and she is I think a very pro-Trump, which Trump is now wanting to cut rates, and I think that has a little bit to do with that. And I don't love the political influence that she may have, that she may be getting, which I don't love that. And Waller. So now we have Bowman and Waller both came out very, very recently advocating for a July rate cut. 2 of the 3, so 2/3 of the permanent voting members are advocating for a July rate cut, and they have a tremendous amount of sway. Not to mention, we're hearing reports that Fed is going to nominate a new chairman, although Jay Powell's term does not end till May of 2026. What they're going to do is they're going to put someone else, the nominee, out there, who's going to communicate to the public and to the markets and to the banks of what Fed policy, what influence he's going to put on Fed policy beginning May of 2026, to i.e. basically turn Jay Powell and Jay Powell's communication into a lame duck term during that time frame. So I think that's what's taking place right now. Now how in the heck did we get to all-time highs in this market rally?
Nice catch, by the way. That was
about to be rates. Where did all that come from? Okay.
Nice catch, by the way. That was about to be a bleep, and you caught yourself. It was a well justified 2-second pause to gather your words right there, because what was about to come out, I think we'd have to edit. We'd have to start checking the box that says that this has explicit content, I believe.
Wow. I mean,
good catch.
Yeah, I was going to say, where in the GM Chrysler now? So where in the heck, where's this rally coming from? I think, let's talk about it. We've had a 1,300 point S&P rally. Okay, we had an intraday low of 48.35 to an intraday high right now of 61.90. So you're talking, 1,400 points almost. Okay, on the S&P since April the 8th. Okay, since April the 8th. obviously, a big part of it was the recessionary probabilities got cut right off on that day, and they have also bled down since then to normal rates. We've seen earnings earnings estimates for 2026 stop deteriorating and start to tick up. They're not going parabolic. They're not accelerating all that much on the upside. But what they're not doing is they're not contracting any further. So what I think the equity markets are now starting to see, and if you look at the 2 years at 372 this morning, we're already past the 375 number that we talked about a couple of weeks ago. That would be not hard to get to 375 by the end of June. Well, here we are at 372. That's the bond market telling the Fed that we think inflation is really cooling down now. Okay. And the equity markets, I think, are paying a tremendous amount of attention to that 2 year. Now, of course, they pay attention to the 10 year, but I think they're really watching that 2 year to see what the bond market folks are thinking about actual inflation, not just the few people who sit in a room and scratch their chins for a couple of days in Washington, D.C., the Federal Reserve. These are the fixed income managers. These are the bond market. These institutions. These people are incredibly, and there's a lot more of them. Okay, and they really could care less what the Fed has to say as far as their opinion of inflation. They think what they think, and they have all the same data, and they have all the same, intellectual horsepower that the Fed does. Okay, and they're seeing something different, and they're doing something different. They're buying these yields. They're buying these yields because they don't think inflation is sticky. So we're seeing the longer end of the curve being a little bit more stubborn, simply because obviously we've had issues with the discussion of the long-term strength of the dollar and the long-term strength of U.S. debt. That could be a problem, and that's why the longer end of the curve has been a little stickier. But as far as the inflation side, the 2 year is starting to move, and I think we could have a 2 year below 3% by the end of this year, okay, which would be huge for the housing market. And the housing market really can suffer pretty quickly. And if the housing market suffers and the labor market really starts to contract at the same time, I don't see how that doesn't, how we don't risk contagion into the equity markets and into the broader economy.
So one of the things that I'll just interject here is that there is, and I got to be careful not to let this go too far, because it can turn into a very, very long explanation. But one of the misconceptions I think the public has is that the Fed directly controls interest rates, and it's not necessarily exactly that they have a red pen that they walk around the country and say this is what the rate's going to be on every single thing. They control policy rate, and then policy rate is going to affect a lot of different things. But to your point, I mean, since April 8th, the 2 years is pretty much flat. But in the last, call it month, since May 14th, the 2 year is down from 405 to, that's 33 basis points. We're down 33 basis points in the last, 6 weeks, 5 weeks. So the market is lowering rates, essentially. Like the bond, the rate in the market right now is 33 basis points lower than it was 6 weeks ago. But the Fed hasn't lowered rates in the last 6 weeks. That's not because of the Fed made a decision that took rates down. The market reacted and took it down. I bring that up to say it sounds to me like you're pounding the table and saying they have to cut now. It sounds like the market agrees with that sentiment, or is already anticipating that. And ultimately, the market is what affects the economy, right? Whatever the market rate is what banks are going to go off of, and that's how they're going to set their interest rates, which is going to set mortgage rates and whatnot. So and you feel free to interject or correct me if I'm saying anything wrong here. But to your point there, I mean, and hey, you call, I mean, our April 5th show or April 4th show, whatever it was, you called for a rip your face off rally. Well, I just looked it up. From the low on April 8th to where we are now, it's about 1,200 points, almost 25% from that point. So yeah, you got your rip your face off rally from that point. But what's the downside? If they don't cut, what happens?
If they don't cut, if they don't cut, so I guess we probably need to have a little bit of discussion of the mechanics of what policy rate actually does. Okay,
Yeah.
The policy rate actually is it's the Federal Reserve policy rate is the rate that is set by the Fed member banks, which is your JP Morgan, your Wells Fargo, your Citibank, your Bank of America, your U.S. Bank. There's 9 of them. Bank of New York Mellon. There's a couple others. Okay. What they lend money to the smaller regional banks at. Okay. And they lend, and that's what they lend them. So what the smaller banks lend to each other at is that policy rate. Okay. So which means when you go to a bank for a loan, okay, for a house, that's the money that bank is purchasing the money for. Okay. So they can't offer you a 6% mortgage if they're buying the money at 4.5%. They can offer you a 7% mortgage if they're buying the money at 4.5%, because that's how they make their money. It's called the NIM, the net interest margin. Okay. So that's how that works. Okay. So if they don't lower that policy rate, then the banks, when the smaller banks, the regional banks, when they're going to a Fed member bank and they're buying the money to lend out for you for your mortgage or your car or whatever it is, they have to charge a higher rate so that they can make their money. Okay. So what's happening now is this looks like the backward version of 2021. What happened in 2021? The 2 years shot right through 3 into 4 and into 5 into early 2022. The whole time the bond market was telling the Fed, you need to raise rates. You need to raise rates. This isn't transitory. Maybe the bond market was saying, you need to retire the word transitory, right? For now. Okay. So, and that's what the bond market's in. Bond market's in exactly the same thing right now. It's at 375 and it's 372. My guess is we'll probably have a decent CPI number come out in July and it'll fall further. Okay. We'll probably have a very lackluster job creation and JOLTS number for June that comes out in July, which will cause it to fall further. And it's going to be those things. And then the market is going to have to get into a place where, okay, we like these lower yields, which I think is causing the market to expand a little bit. The trade deals, all these things are happening. But there's this hangnail on their toe that's causing them to run real fast. And that's these interest rates. Okay. Yeah. So if these interest rates don't start to come down a little bit, the economy is showing signs of cooling. Not the interest rate. The economy is showing signs of cooling. So is it cold? No. Is it cooling? Yes. Will it stop here? No. Okay. What would cause it to stop almost here and potentially turn around and go the other way? That the equity markets would have the ability to see through, because they're looking into 2026 already anyway. Okay. That would be a true acknowledgement that inflation seems to be in the rear view mirror for the most part. And maybe an acknowledgement of, hey, but we'll be flexible. And do we really think if they cut 25 basis points or even 50 basis points in July, that's going to have a material impact on inflation? Of course not. Okay. And if they cut 25 and then cut 20, if they were cut 50 and then 25 and then 25, and then maybe they take a full point off of this thing by the end of the year. So we're sitting at an upper bound of 3.5. Okay. And they hold that for a couple meetings and they can always go back up. They're not stuck anywhere. So I don't understand. We were having a little meeting this morning. What I don't understand is why this Fed doesn't want to be flexible from meeting to meeting. Okay, it seems like they want to be pedal to the metal. Rates are zero. Rates are zero. Rates are zero. Oh, well, we missed that one. Let me shut this economy all the way down and raise rates by the fastest speed in history. Yeah. Looks like we're going to get it wrong again. Now we're going to have to start chopping rates to keep this thing from going into a recession. It seems to be a bathtub sloshing policy behavior. Like it's either all one way or all the other, right? I think if they were to moderate their policy adjustments and say, hey, we're going to be flexible here. Say we're going to start cutting. We're going to start cutting. If we start to see signal 3 or 4 months directionally in the same way that we don't like, we start to see inflation. We're going to hold. And if we start to see it more, we might actually have to take one of those rate cuts away. That's perfectly okay. There's nothing wrong with that. Okay, but just sitting in your chair and scratching your chin ad nauseum forever, saying we're going to wait it out until most of this uncertainty is past us. We're going to wait it out until most of this uncertainty is past us. Well, there is no such thing as no uncertainty. And what's funny is they talk about this uncertainty and they have to get through this uncertainty before they're willing to do anything. But then in the same meetings, all the time, they say forecasting is inherently difficult to do. And we know we're not going to get it right. Right. You are correct. No one believes that the Federal Reserve has a crystal ball. You have very smart people with a lot of data, okay? But there's also a lot of hard data that's directionally negative with the economy. So, there's nothing wrong with saying, there is uncertainty. There will always be uncertainty. But what we do know now is we've had some cooling on the consumer side. We're not seeing anything on materially manifest itself on the inflation side from, and no tariff imposed inflation. So we're due for a rate cut, and we'll go down this road until we think maybe we need to hold. And then if we need to hold or adjust back the other way, we can always do that. I'm just not understanding. I'm not understanding the permanence, I guess, for lack of a better word, of their policy positions. That it takes, literally the president and the entire Congress and the bond market screaming at the top of their lungs for them to do anything.
Yeah. Well, as always, we'll wrap it up here. The Intelligent Investment Show is for your entertainment, education, amusement, and whatever else you want to call it purposes. We're not here to tell you what to do with your money. And the simple reason that I like to say for that is neither Matt nor I know anything about your financial situation. So it would be really foolish of us to tell you what to do with your money. That's not very professional of us. So that's not what we're doing. We're just here to talk about the market. However, that's a great way to segue into a plug for Matt's business. If you would like to seek professional financial advice and work with someone who does get to know your financial situation so they can make advice. My English is getting terrible, man. But we've got to work on our English language in the South here so that they can make recommendations and give you advice. You can contact Matt and his team at ARPG at 702-655-8300 or visit intelligentinvestment.com. Matt has the best hair and the coolest website domain in the industry. I think that's a compliant endorsement, right? I can't necessarily say you're brilliant or any of that kind of stuff. That gets me in trouble because that's an endorsement. We got to fill out a bunch of paperwork. But I can say you have the best hair and the coolest website domain, I believe.
We do have a cool domain name. My hair, I'm having a decent hair day, but it's all a facade because I'm a huge nerd.
I just noticed when you look down there, you've got a straggler there. One of those front ones is kind of out ahead of you. Right there.
Yeah, it's definitely doing like the Clark Kent thing, isn't it?
Yeah, you got to work on that after the show. But as long as it's three-dimensional. As long as you're looking straight on, can't see it. It's a facade. It's exactly what it is. It's a facade.
There we go. Less wind resistance.
Now we're getting somewhere. All right, Matt. Enjoy Tahoe, man. So you head to Tahoe next week?
Me and the family, we're going to go up there, celebrate the 4th of July. It's wonderful up there. It's beautiful up there. It's my wife's favorite vacation destination, and it's quickly becoming mine. So I intend on enjoying a few adult beverages, gaining some weight, and looking at the back of my eyelids.
Yeah, sounds like a fantastic 4th of July. Happy birthday, America. Well,
happy birthday, America.
We'll see you July 11th. We'll be back live July 11th, and I'm looking forward to a well-rested and recuperated Matthew Dahl on the Intelligent Investment Show when you get back here in July. See you, brother.
See you.
Have a good one.